Hello Propenomix people, and welcome to the Sunday supplement from the 19th of November 2023. For regular listeners, they know I like to start with a quote, and this week's is, "I think for anyone who's gone through a crisis, there comes a turning point, an epiphany, that marks the beginning of the end." And that's from Deborah Norville, American journalist. Please can I ask up front that if you're listening and you don't already subscribe to the YouTube channel or follow me on one of the podcast platforms, that you do please subscribe. I know that about 40% of people watching this on YouTube aren't subscribing, and if they would, that would help me with the algorithm and the rankings very much and help me bring you more content in the future. So, it's been a juicy week this week by any year's standards, without doubt confirmation of the best macro news we've had in 2023 thus far. Of course, there are very few headlines about it, and it certainly isn't reported with the same vigour that the next crisis will be reported. But that's news media for you, right? What's got me quite so cheery, you ask? Well, firstly, don't get too excited. I'll be bringing us back down to earth, as always, in my inimitable factual style, busy on that quest for the truth rather than the sensationalism, the clicks and all the rest of it. When I look at it, my own YouTube algorithm, where I do the majority of my learning these days, reflects exactly this: factual commentators. I find myself deliberately staying away from clickbait as if it will intellectually pollute me, even though I know some of the content is worth me allowing the title creators or the marketeers to have their way. Anyway, having managed expectations, inflation did, as predicted by many, get under that magic 5% number this week. CPI inflation anyway. Don't get me wrong, regulars will know that the horse hasn't only bolted, he's also fathered several foals and jumped 56 fences in the interim, but the stable door finally looks like it is at least back on its hinges, and the horse is quite tired. Into the detail, as we will need this information to build up to a clear picture of 2024, which I will deliver in jigsaw-style format over the coming weeks. We have to get into the weeds before we do what the markets have already done, and assume that the problems are all over. Let's revise a few of the points I've made over the past 3 years regarding inflation. Firstly, inflation when over 5% is seriously dangerous and out of control in any modern post-industrial Western economy. It affects everyone. No one is safe. Without control, it damages the fabric of society itself and makes the poor even poorer. But its damaging effect is quite literally across the board. That's why it gets taken so seriously. Secondly, services inflation makes up 47% of the current CPI inflation figure. More on this later. Thirdly, a bit of inflation is far better than none or deflation, which is even more damaging to growth and living standards. Fourthly, it is easy to lose decades without progress if deflation occurs. Fifth, historically, in inflationary cycles similar to this one, the most recent being the early 1990s, the top to bottom, so that's the breakout above the inflation target to back below target, is often 5 or 4 years long. It certainly is in a recessionary environment. Sixth, inflation is sticky. The journey from 5% or so to 2% or so is likely to be an arduous one. Seventh, does anyone really believe the government is unhappy about inflation around the 3 to 4% mark for a period of time? There's a lot of debt to inflate away, after all. And eighth, inflation offers opportunity for profit maximisers, i.e. companies, and it provides an excuse or a reason, or both, for all sorts of behaviour, but primarily price gouging. Don't worry, the Bank of England has investigated and found no evidence for this. Frankly, they haven't looked hard enough. Nor does anyone know, really, what would be done, apart from brand damage, if the companies were found guilty of this. That's why it's landed on the bank's desk. So where does that leave 2024 at first pass? Inflation under 5%? Should be. No reason why not. Although, how much below? Barring a black swan. Wages putting upward or continuing pressure on the inflation rate in general if they continue where they are. And 5.6% is enshrined in the National Minimum Wage, MW, for next April already. So many public sector jobs are now defined by where MW is that it will now be nearly impossible to see wage inflation far below 5.6% in April, And 2023 has been the year where managerial and executive pay has caught up a bit after all the upper hand, in percentage terms, being with the lower paid since COVID. If that's enough to feed spending, and of course it may not be, as people catch up with continuously higher rents and more people drop off fixed-term mortgages, then that's inflationary, of course, at a level over and above 5%. Next year could easily be an inflationary struggle between 3.5% and 5%, one that secretly the government would enjoy to inflate away debt, but not if their spending has to go up above inflation, of course. The September wage numbers were 7.7% up. This is the 3-month year, i.e. the rise between July and September, but annualised, without bonus, and 7.9% with bonus. There's a lag there, clearly, and this inflation print will only have really kicked in within 3 to 4 months, as far as the figures reporting goes on wages. Nonetheless, you can see how far ahead of 5.6% that is, and we don't have the same reason for a sudden shock downwards that we did in CPI in October, thanks to energy prices normalising at least a little. Remember our 47% services inflation contribution to CPI. It still baffles me that this doesn't see services inflation in the headlines more. This is so important for the future of CPI. I've made it this week's graph, where you can see just how much that hasn't fallen like CPI has. 6.6% is the number for October, and the 3-month year, to align with the wages, perhaps unsurprisingly, is around 6.7%. In simple maths, rounding the 47% to 50%, services inflation at 6.6 makes CPI 3.3 without the other components. So unless goods are actually dropping in price, and of course energy has, and food also has, then that tells you the absolute floor for CPI. We did have some energy and oil price spikes in terms of fuel costs in October as well, of course, because of the Middle East situation. Otherwise CPI would have been even lower. So until companies stop putting their prices up, which won't happen until wage demand tempers significantly, I don't see CPI breaking that 3.5% low next year. Of course, so much depends on expectations, but traditional or textbook economics falls down here as it so often does. In the world of academia, wage demands are based on inflation expectations, whereas in the real world, where the majority of workers don't understand or particularly care about macroeconomics, in this sort of environment, the first priority of the worker has been to try and maintain their standard of living, which has required some catching up on what's already happened before considering keeping up with what's going to happen over the next 12 months. There's no mechanism for really understanding that at the governmental or employer level, but that's pragmatic economics rather than dry, sterile economics. People need and want to catch up before they can keep up, basically. The CPI number, before I completely rain on the parade, was 4.6 for October, and, as is always important, it was below the expectations of 4.8 in the market. I've spoken many times this year about how important it would be when we start to undershoot expectations, and this was such good news that it sent those gilt yields that are so important to mortgage costings right down to new lows. Thursday night's close at 3.991%. Round numbers are always psychologically important when trading markets, so that little bit below 4% at the close is so important. This was the lowest close since the 23rd of May this year, nearly 6 months. It then dropped at the 8 a.m. open on Friday to 3.85% fairly quickly, rather than going back above that 4% resistance level. For technical analysts, this signifies that the near future lies below 4%, unless something changes, of course. And the 4% was tested before the close, but we closed the week at 3.96. Where does that leave mortgages for new products for the rest of the year, as at today? Well, around 5% with a 5% fee. Or some 4.6 with a 7% fee, might be perfectly likely. I switched one loan down to a 4.757% fee on Friday itself. Some lenders, Paragon likely the best example, MortgageWorks also, could go lower because they access funds from savers rather than just from the swap markets or the other bigger banks. The headlines created are helpful for managing inflation expectations going forward, and as redundancies continue to mount, as they will in the new year, this will significantly affect wage rise conversations, of course. especially as the opportunity to pass on increased costs will also decrease significantly. Core inflation, which has been popularised as a more stable measure as it strips out the volatility of food and energy, is still much higher. 5.7% was the print, with 5.8% the expectation. Another reason to be somewhat positive, but above 5 is still uncomfortable. With food and energy down for the month, it's obvious that core would be above CPI, of course. If you looked at core on a 3-month yearly basis, to put it into context with the rest of the discussion today, it would be coming in at just under 4%, which is much more manageable. And indeed, the last 5 months' worth of core have not seen a print above 0.5% monthly. Worlds apart from February to April 2023, where the monthly prints were 1.2%, 0.9% and 1.3% respectively. Truly an out-of-control situation. The retail price index, for those who may still have any leases linked to RPI, printed 6.1%. Still dangerously high, but well under the forecasted 6.4%. Generally, relief, but the concern I have for services inflation still looks well justified. And that will, of course, drive the wage demands and CPI in general, because we lack that event like we had with CPI in terms of energy and the price cap dropping in October. Guess what? While we're on the price cap, we're back to an increase in January 2024, although the 5% rise on that date will be matched by a 5.7% forecasted fall for April 2024, and that will again be helpful. The current forecast is for significant stability in unit pricing after April, which will be most welcomed, but then most forecasts usually look like that. I look at Cornwall Insight, who tend to have the best price cap analysis for those who are interested in the sources. That's the comprehensive inflation roundup out of the way. My dose of realistic misery will just say the markets have priced all this in awfully quickly. It's a bit of a classic I told you so, as everyone forgets that many were predicting that rates would be right back down again by the end of this year, i.e. they really didn't tell us so at all. The likely outcome here for early 2024 is just more sludge, really. The bond markets are now suggesting there will be 3 interest rate cuts of 0.25% each in 2024, with the first one coming around springtime. That would see base at 4.5% at the end of 2024, which is perfectly possible. Where would that leave the 5-year gilts at the end of 2024? Perhaps around 3.5% or so? Although caution is needed here. This is where we have to discuss the yield curve. Remember, the yield curve simply plots the yield of each bond in terms of its duration on one curve, where the horizontal axis is simply time and the vertical axis is yield. At this time, the curve is inverted, meaning that you get a better interest rate for money invested over a shorter time frame than a longer one. The 1-year gilt is still hovering around 5%. That makes the mathematical example a little less painful than it would otherwise be. For the sake of keeping this simple, please be aware this isn't mathematically perfect, for the purposes of trying to explain rather than be technically correct. If I get a 4% return per year from a government bond for money invested for 5 years, but I get 5% in the first year, then if you consider investing £1,000, on the 5-year bond I'd get £40 interest each year for 5 years, and I get my £1,000 back at the end of the period. On the 1-year bond, I'd get £50 interest in the first year and my £1,000 back at the end of the period. So if I took the 1-year option, I'd have £1,050 after 1 year. In order to get the same return as the 5-year was offering, I'd need to invest that £1,050 in a 4-year bond at around 3.5% in order to get the same £1,200 back that I'd get if I just bought the 5-year bond at 4% interest. Arbitrage keeps these markets fairly tight on a second-by-second basis, so that's a good stab at the 4-year gilt yield in 1 year's time. What will that new 5th-year part be, however? Well, that can be estimated by looking at the current distance between the 5-year bond and the relatively illiquid 6-year bond yield, which trades a little higher at time of writing. So perhaps 3.6 or 3.55 would be a better estimate. And look, I've got to be clear, that is only today's estimate with all the information we have today. Things will change over the next 12 months. But if that was correct, that would see some 4.5 to 4.6% rates with a 5% fee, or some 5.2% rates with a 1% fee, or something in between. A return to those days might be very welcomed at this point, even though we might have choked on our cornflakes. Other breakfast cereals are available, and always remember that breakfast is the most important meal of the day was simply a marketing slogan popularised by J.W. Kellogg. We might have choked 2 years ago at the thought of that sentence. That, I hope, puts into context just how low, or not, rates might currently go by waiting, which I'm almost never a fan of. Wait a couple of weeks or so. Sure, that can be tactically wise when there's been a big drop in the yields like there has recently, so that new products can be released. Lenders can be a bit slow at putting prices down, in case you hadn't noticed. Wait 6 months or a year. Well, that could be a great buying opportunity turned down right there. Don't do that. Excuses for inaction do not build balance sheets. Remember my Q4 2023 soapbox as well. If your broker is not checking the rates on any existing applications have gone down before they get to offer, they are not looking after your best interests. Make sure that they are. At this time, yields have fallen really significantly over the past month, a bit like they did when Sunak took over from Truss, and the market is repairing. Make sure you ask these questions and keep asking them until you get to offer, and perhaps afterwards, because some lenders are very fair indeed in these situations, although they might charge you an admin fee for a new offer, which I think is fair enough. So inflation was not the only fruit, but we were overdue a monster update, and since it was the first really juicy good news on that subject for over 2 years, I thought I'd make the most of it. Unemployment held at 4.2% for September, rather than rising to 4.3% as the forecast suggested, and wages, as discussed, held up at nearly 8% rise, including bonus. There have been a number of one-off bonuses, but remember the 3-month year is still 7.7 without bonus. These are looking backwards, and I expect January's numbers to look very different as discussed, but we will only know then. The tight labour market looks ever tight, but slightly less, with 957,000 job vacancies. The pre-pandemic high was 865,000, so it's still a high print, but the number 18 months ago was 1,302,000, and we are down 26.5% since then in terms of job vacancies. The top category backpedaling with a 35% drop quarter on quarter, real estate activities. That perhaps won't surprise. Construction is third with only a 10.9% drop quarter on quarter, although there are still 32.2% more construction vacancies than January to March 2020, where there are 36.4% fewer real estate activity vacancies since the same period. You remember there's a little bit of seasonality in those figures as we approach the end of the year, but still really significant drops, especially in real estate activities. The smallest companies are shrinking vacancies by the largest percentage, as so often the pain bites in the smallest companies first. Overall, though, the labour market hasn't tightened as quickly as expected, in a carbon copy of what's already happened in the US with their faster cycle, and that should put serious caution on those who think this is over. The phrase I've tried not to overuse this year, the soft landing, i.e. that we'll just conquer inflation and well done and there'll be no major consequences, is peaking in interest as companies report this to their shareholders and investors. This is an unlikely outcome, and as I've said before, if we get there, it will be by luck, not judgment. There's really only one way we can get there, and that's that the inflation, as I joked a few years back, was indeed transitory. It's just that transitory meant a few years. There is reason for that inflation to drop out of the system more easily than before, although the bad news is that's already happened. In the US, it leaves CPI at below 3%. If we consider the world price of commodities only, which were a major factor in this inflationary cycle, in the UK, we've only just got under 5%, and we also have to battle a strong dollar, which doesn't have the same impact for the US since they trade in dollars by default. So I say again, the path from 5% to 2% has historically been difficult and never without recession. Unemployment doesn't usually rise a bit and then tail off. It normally becomes a self-fulfilling prophecy. And for next year, it's very clear from corporate America that layoffs are absolutely on the table. Companies want more and more profit, and the only way it's easy to achieve is reducing headcounts and making people work harder. An insider told me this week that expectation is 20% increase in margins, only to be achieved by M&A arbitrage and cutting costs stateside. The pandemic might just give us an occurrence that only happened once in the last 43 years, a soft landing. But again, I say, more by luck than judgment. It's also worth saying that the Bank of England has massive latitude, really, in when they reach the 2% inflation target. That's convenient, I hear you say, because the government really don't mind a bit of inflation as long as it's contained. If it takes years but preserves the housing market, which is going to get some kind of boost in next week's autumn statement, as the Chancellor has money in reserves, although the Office for Budgetary Responsibility forecast will dictate how much is needed to plug a bigger gap last year than they budgeted for, just like every year, and also preserves social stability and keeps repossessions down to a manageable number, then rates can calm off a little if the hawks on the Monetary Policy Committee follow the party line or remain out on their own in a little posse of three. That's likely deflated everyone enough for the day, but the central message is act cautiously, act as if there could still be a credit shock, but of course, keep calm and carry on. Next week, we have the autumn statement from the Chancellor, who survived an eyebrow-raising reshuffle this week. Will SDLT be cut? Inheritance tax tweaked? Some even think Section 24 will be repealed. I checked, and no pigs were harmed in the making of the supplement by flying past the window or crashing into the clouds. Until then, if I say again, if you haven't subscribed already to the channel on YouTube or the podcast platforms, I'd really appreciate it if you do. That way, more subscribers will lead to better content. I'm at 463 YouTube subs as I'm recording this, and I've said if I get to 500 before the 1st of December, I'll post an economic advent calendar every day with some daily explainings of economic concepts relevant to property investors, developers and traders. And if that isn't enough of an incentive to subscribe, I don't know what is.